AI creates cost efficiencies and more stuff gets done, more economic value gets generated.
I buy that if it's trickling down, so to speak. I'm skeptical potentially if it's up to sort of the people with more money to stuff it under their mattress, but to actually give back what proportionally what needs to be given back.
Like if people say the market is rigged, and that's true, but what people are missing, it's rigged in our favor. For an advertising-free version of the show, check out patreon.com/Wall Street Wildlife. Hello and welcome to Wall Street Wildlife with Krzysztof and Luke. Last week we had so much to talk about, we didn't get round to it. So this week we are picking up the topic of Coatue. They have just published their fantastic 40 Growth and Innovation Index, which is a list of the 40 companies they believe are best positioned to lead in an AI and technology-driven world by 2030. These guys are legit, so listen up. What stocks did they pick, and what are they missing in our opinion?
Okay, what makes these guys legit, Badge? I have not heard of them before.
And I hadn't either, but they got shared with me by a Discord buddy from the Dividend Talk Discord, Kalen, who said, check out this deck. And he gave me a couple of data points to go and do some research on. They were founded in 1999 by Philippe Lafont, and they got a good pedigree. And the reason I think this is really relevant for Wall Street Wildlife and our listeners is they kind of follow a very similar methodology to you and I. They invest in both private and public companies, and that gives them like a lens of what's happening in private markets they can apply to their public investments. They're serious players with nearly $60 billion under management, 60, that's a big number. They move markets, but their philosophy is certainly close to my own. Like they try to identify secular trends. So right now they're talking about things like AI, cloud computing, and fintech, and they try and find like the category leaders who are going to position or best positioned to benefit from those shifts over the long term. That's kind of what I do. I use different words for that, but like I try and find companies driven by technology and innovation who are selling products and services the world needs more of in 10 years' time. And this is interesting because they make some specific predictions, which we're going to get to at the back of the episode.
How do they differ from Kathy Woods's venture? Do you have a sense for that?
Good question. I don't know. I imagine they're the same sort of thing. They're not as prolific on social media, like selling their spiel and their wild price targets, and they manage their own money plus money for their clients. So maybe, I don't know, maybe similar, but they don't have the same social media game. But I think, well, I mean, let's take a look at some of their holdings back in 2013. So what, 12 or 13 years ago, like they owned some big winners. Like they had Amazon back then. They had like most of the Mag 7 you can see in here. They're missing NVDA, I guess, but they certainly own that now. Plus a few donkeys. But like if you look at this portfolio, I did a little bit of analysis on it to understand like how are they doing their strategy. Like they had Tesla, and that's been like a 45 bagger for them through to date. They had Facebook, now Meta, and Intuitive Surgical. Like those have been 9 baggers. They've 11 baggered their investment in Netflix and Amazon. And even if you ignored everything else in the portfolio, like their exposure to those stocks more than makes up for like the few losers they've had.
Yeah, though I do want to talk about the donkeys. Everything's obvious in hindsight. And like you said, a big winner will more than make up for the losers. But trying to understand, going back a decade, what the rationale is, for example, investing in the Gap, which is a retailer, clothesline. I mean, in the moment like 2013, if I could remember, the internet is still sort of wet behind the ears. Things are really growing fast. Why? What was the justification for including that kind of company, which now, and again, in hindsight, seems like an obvious flop?
Yeah, but I suppose, to give them kudos, they only had a 0.75% allocation to it back then. So obviously it wasn't like a high conviction idea for them. And their highest allocations, okay, Amazon, Apple, like those were good investments. Obviously they've got a couple like who the heck are Crown Castle and CBS Corp? Like that's like a news channel, right? Like 8% in CBS.
Yes. Crown Castle, I'm pretty sure, is a kind of real estate REIT. But still, it's not even, yeah, even put it this way, like, to, I'm maybe repeating myself, but I could understand, say, buying Netflix and Pandora, and then one of them really works out and the other one doesn't. But well, maybe I don't know. Maybe they really thought Gap was going to take over the world somehow. I just can't, go back that far.
I don't know. And I can't, I haven't been able to dig out, even with Kaylin's help, any of the DD from back in 2013. Presumably they had some rationale. Like today, we're going to focus on looking forwards. Like what's their rationale for the next 5 years and what are their predictions and their recommended, well, fantastic 40 for 2030. So I think that, and we can judge their methodology there. And I do have some thoughts around that. I am just going to say, but there's a good reason for this. So they seemingly have six baggered their AUM, their money, their assets. From 2013, they had about $10 billion. Today, looking at some like disclosures and reporting, they have about 62 billion dollars. So they've like 6x their money. If I look at my own performance over the same period, I've 15x'd my money. So Philippe,
So how did you do this, Badger?
well, investing in the same companies pretty much, but getting into some of them much earlier. I was in Intuitive Surgical, I was in Apple, like before these guys. I was in Netflix and had a much bigger allocation to Netflix. Like that's part of it. But there is something interesting here, right? This is the advantage that we have as retail investors with our, meager, tiny investments that don't move the market in any way. It's hard for guys like Coatue and ARC and their like to make like big bets because you move the market. And if you wanted to buy like $500 million worth of stock in something, even if it's relatively liquid, like you can't do that in one transaction. You have to go on, you have like a special mechanism. You don't just go and buy the stock, and you have to do it in tranches. And you also get slammed by regulations. Like if your assets are above a certain level, and certainly these guys qualify, like you have to disclose if you have a material stake in a company. So it's not like you could do something like secretly and build up like a stake. Once you have what I think more than 5% ownership of a company, like you have to disclose that. You have to file a public report to the Security and Exchange Commission. And then also, like you suddenly have like insider status once you own more than 10% of a company. And that's going to put like other constraints on you. Us little retail investors, that's our massive advantage over the big boys because we can just make we can build highly concentrated portfolios if we want, and our numbers are nothing like this, so we can have like big exposure to micro caps if we want to.
Yeah, I'm glad you said that, Badger. There's a huge number of people that falsely believe that they can't beat the market. And that's probably because, statistically speaking, is it most like hedge fund? It's the numbers that hedge funds don't beat the market. Like they have one great year, right? Then they put their shingle out. Look how great we are because we did this, but then they don't repeat their performance for all the reasons that you mentioned. But individually, I think as long as you're willing to do the work and to educate yourself, you could be much more nimble and you don't have to, you're not susceptible to all these regulatory hurdles. And so beating the market is totally possible. So, tip of the hat to you for whooping, for having your results whoop this pretty serious investing house.
Yeah, well, I'm whipping everybody's ass, so they're not standing alone, right? Like if people say the market is rigged, and that's true, But what people are missing, it's rigged in our favor for all of those reasons. It's rigged against the big institutions and the guys with all the money and all the massive like processing to do all this, really like dark arbitrage and weird stuff. It's rigged against them. So it's rigged in our favor because they have all these other, they have to report to their investors every quarter. And if they're not showing, chart goes up. And if they're not in like the hot stock of the moment, then they're going to get like their investors bitching and withdrawing their money, and this AUM starts going down and the whole model starts breaking. We're not accountable to anybody. Like you and I, the worst thing that will happen is if our portfolios fall apart, like we're going to impact ourselves and we're going to look like idiots on the podcast in a couple of years' time if we've massively underperformed the market for like a whole cycle. Like I'm happy to underperform for a couple of years. That's the nature of the game. But like if we're clearly bad investors, we're going to look dumb and it's going to impact our lives. But there's nobody saying, "Oh, Luke, like I want my money out because you're failing as an investor." I just need to convince myself, and that's such a powerful asset to have.
Amen. So their methodology,
Hmm. Yeah,
spell it out
it's.
for us.
I think it's good. Like it's a good start, but I do. But by the time we get to the back of this conversation, I do have a bit of a critique, possibly. So the methodology is they take the top 150 public and private tech companies, I think just by like market cap, like the 150 biggest. Then they look at growth over the last 5 years. Like, are they compounding returns? Like, is the valuation growing? And then they exclude companies facing multiple compression versus the market. And I'm going to come back to that at the back because I think the way it's written is wrong, but actually what they probably do is right.
And so, if I could translate this into normal speak, it seems to me that this is the way you mostly invest, and this is the way I used to mostly invest. You just take the best companies in the world. How do you define best? Well, you look at the numbers, the companies that are growing the quickest for an extended period of time and have already established themselves. That's the pool that you sort of swim in. And from within that pool, you then, I would say, filter the companies that most catch your eye or perhaps most have the most number of tailwinds due to macro forces, and then you sort of winnow down. But one way or another, you're dealing with the best of the best.
Yeah. Probably if there's any of these like filters, I don't apply. It's the first one. I don't just look at the top 150 companies. I'll look at all ends of the market.
Right, but they certainly this procedure certainly goes against more than 50% of my current portfolio at the moment. They're not even looking at small stuff. They're not looking for relatively undervalued companies. They're certainly not looking at problem companies in any way.
Yeah. Well, because again, though, because they can't, right? Because like when they write a check, like their checks are 50 to $100 billion, sorry, $1 million to start with. Like some of your companies, that's the entire market cap of some of the stuff you own. Yeah. So, yeah, the nature of being a big boy, you can't make small bets. Anyway, I think the methodology is robust and it's appropriate to their scale.
That's kind of, I mean, I don't know if it's obvious, but it's a kind of interesting to me to see that they label the tech periods by their name: mainframe to PC to networking to the internet 1.0, mobile internet, web 2.0 to the cloud, SaaS era. And now we are at the beginning of the next wave. They're calling it AI, obviously, but each curve is higher than the previous one. And they give examples of each company that fits the curves. And so,
Yeah, I like this. It's a good diagram. I like this, and I agree with it entirely. And like the comment that like each hump is getting higher and higher, like that's accurate because back in the 1960s, like technology was here, and companies like IBM and HP, they've called out where like that's like the 60s through to the 80s, like those were important companies, but like technology wasn't driving the world in the same way it is today, and now like in the cloud and software as a service era 2015 to 2020, companies like Amazon and Microsoft are far more dominant and forces in the world and like shaping society. And now what Coatue are calling like the AI era or wave, and companies like Meta, Microsoft, NVIDIA, OpenAI, like if you're in business, if you're not using AI, like that's it, you're toast. You're going to get eaten up by the people who do.
I think the one critique I have here in this moment, because we have hindsight in favor, is let's go back to in our favor is let's go back to the 2000s. Their examples for what they called desktop internet web 1.0 was Facebook, Google, and Amazon. Those were obviously the big winners of that decade. But we know there were like hundreds or thousands of companies that showed up, tried, failed. And I think
And, yeah, yeah,
so I think this is the trick. I mean, if it was this easy, we'd all be multimillionaires, right? But I think the problem here is that today every company is saying they're an AI company, and every company to some extent is using AI. That's not the problem. The problem is, can we identify what I guess they would call the foundational, call it backbone, like these are the companies that will make everything go in the future, and that will require much more than saying, yeah, AI is the next wave and let's just invest in AI.
yeah, totally. And they've been a bit like economical with the truth, right? Because if we're talking about like the desktop internet era in the 2000s, like where's Microsoft, right? Surely they are the number one, and surely Apple, right? They are, up there as well. That was the desktop era. It wasn't really companies like it was Google, but they weren't super dominant until like the end of the 2000s, and it's more like the last 10 or 15 years have been Alphabet's era.
Right. But okay, so the optimistic point here, though, is that it's so obvious that from an investing standpoint, we are still at the very beginning of what looks to be humanity's largest wave of innovation. And that's beyond, I don't know, it's beyond cliched at this point, but the world will be transformed in the next 10 years, and the companies that do most of the transforming will be the biggest investing winners.
Yeah, no doubt. Let's have a look at how some of this has changed over the years. So this is again a backward looking thing. This wasn't like predictions they made. I mean, maybe it was, but we don't have that data. But what this slide is, it's a slide they only published a few weeks ago, and it's like who were the biggest companies in the world in 2015, in 2020, and today. So it is interesting to see how some of these names sort of move up and down the list and come and go. Anything that caught your eye in particular?
Yeah, I mean, it's hindsight. I'd noticed, for example, Visa
Hmm.
is like at one point Visa and Mastercard. They were there in 2015. They were there in 2020, and then when I look at it today, Mastercard is there, but Visa is not. And as somebody who is, really paying attention to Chainlink and the new global paradigm shift that might be happening, I'm like, is MasterCard also the next to go? I don't know.
Yeah, they are both there, but they sort of haven't moved materially, certainly compared to some of the other winners. I guess Visa's dropped 2 places, and looks like Mastercard has dropped 5 places. Yeah, I had some thoughts on Adobe. So they weren't really in the a tech leader in 2015, but in 2020 they were like top 20 with 188 billion-dollar market cap. Like they've dropped out of the top, whatever this is, top 25 or so universe. And like, I think they're on a like declining trajectory. I mean, they have all companies seem like they're getting their lunch eaten by AI, despite like the efforts they've made to acquire and build some of these capabilities.
Yeah, a bet I would make for another company that drops off will be Walt Disney.
Yeah, that used to be a company close to my heart. I bought it for like the kids in the family years ago, and I sold it like last year, just a bit of a shambles.
Although it is interesting, I want to go back to them because these guys have really put Oracle back on my map as a company to do much more research on. But it's interesting. You see in 2015, Oracle is near the top in the top 10. Then they drop to call it the bottom third of 2020 and then now they've moved up again. So, and I imagine they're going to keep moving up based on my current understanding. So it's not like once you start falling, it's inevitable, but those companies definitely need to have a serious pivot in there somewhere to make that kind of to fight off.
That's a really interesting transition to like another slide we picked out. So on this slide from the Coatue deck, they're highlighting who they think the new class of AI winners are going to be. So this is like, the current wave, and now they're starting to look to the, like, this is a 100-page deck. We'll drop a link to it in the show notes. Go read the whole thing. It's actually quite interesting. But they certainly have Oracle there as one of the like future AI software winners. And it's not really on my radar either. I think one of us should check it out.
Yep. And obviously, yeah, this deck is, I mean, this slide is incomplete because my question is for AI semis, for example, when they call that the key driver token growth, new inflection in computer demand. I, as an AMD shareholder, wonder why AMD is nowhere as far as I have seen on these decks, and it's already a 200 something billion-dollar company. So do they not believe the thesis, or are they just being, picky in what they selected? Interesting question. But for a little bit of confirmation bias, I do love that they have AI power as one of their main themes. In my King of the Jungle portfolio, I have three companies that represent that trend.
Yeah. Have you looked at all at the companies they call out, which are GE Vernova, Constellation, and Vistra?
No, but this is exactly why something like this is valuable. They are in my to do list, to research list.
Yeah. Very good. And
Small, quick, sorry, small, just hint, value drop for our audience. I recently added a very small position to my real money portfolio, Bloom Energy, and I'm planning on doing a Safari stock segment on that, but that fits entirely in the AI power domain.
good stuff. Very good. Very good. And like it makes me rue how I navigated small modular reactors. Like I was one of the first guys to start talking about new scale power, ticker SMR, and I recommended it as a seven investing lead advisor. But I sold out a year ago. And I'm still conflicted around this because like AI power, like that's small modular reactors are a potential answer to that. But like I sold out because I think I was just too early to this segment. Like this, like nuclear power, even small modular reactors, like that dream is 5, 10 years away, and like the need for power is today. So actually, unfortunately, it's like non-renewables are going to service that need, and hopefully, like the superior economics of solar and battery is going to grow that as a providing source as well.
Oklo is in the same category, correct?
Yeah, yeah, absolutely.
Now,
Yeah,
when I hear you say that, I compare that a little bit to the quantum problem, a little bit, because I wonder. Here's actually, I predict this: when times are fine and the market is ripping, these companies, basically everyone's excited because they will be the future, just not yet. But now, just turn the script around. When the bear comes up, there's still nothing to show on the financial sheets. Which companies are going to get absolutely murdered? It's exactly the ones you mentioned because it's just a little too soon. So you're a genius on the way up, but you're going to be an absolute fool on the way down. And I think all you are doing is playing it relatively conservatively and saying it's still a little bit too early on based on the fundamentals. So you're going to wait, and the fact that you missed or whatever, sold too early, however you want to call it, I don't think that's an error of process. I think that's an error of result, which we.
maybe a bit of both, bit of both. Well, anyway, you forced me to become an EOS shareholder, so I guess I'm now invested in AI energy anyway.
Good on you.
kind of an aside a little bit from the whole story of the deck, but I thought this slide was quite interesting. And they're drawing attention to major market downturns since the 1980s. And they're kind of classifying crises and then corrections. And so, like directionally, it seems like they class something as a crisis if it's like above a 30% drawdown, and a correction if it's 15 or 20% up to about 30%. And they sort of stick a pin in that and say, okay, generally we seem to have one crisis per decade and two corrections per decade. It's pretty interesting. Like, we've only been investors through a couple of these.
The main takeaway, I think, with these is they will happen, but you have to survive them in order to keep in the game. And this is why one of our main rules is do not use margin ever under any circumstances, because that could wipe you out. And that's one of the things I learned very early on in my investing career in 2008. I lost way more than I should have because I took too many risks then.
Were you were trading on margin back then, were you?
Uh, yes,
Wow.
or
Okay,
two.
I didn't
Yeah,
know.
I mean, it was lesson learned, the very hard way. The only other crisis that I lived through is 2020. My own actions there are a little bit unusual in that I actually believed that we might be entering into a global Great Depression. So I took out a huge chunk of my investment earnings and I paid off all my mortgages. And so, I was basically, if nothing else, I'm living clean. And I don't think I ever told you this. The few things I kept were a bunch of CrowdStrike calls, which ended up going up by the made massive, amount off that. So I just played COVID perfectly.
Well, I think I played COVID more perfectly because that was 2020 was the best year I've ever had, and that's the one that got me to retirement. Like, looking at Coatue's deck, the market peak to trough took a drawdown of 34% in 2020. I don't know my peak to trough, but my whole year 2020, like, I nearly doubled my entire portfolio. I was up 90%. And I think, like, I need to go and weed through exactly how I got there, but I definitely did like reposition into what I felt were like the work from home kind of stocks, things like Zoom and a bunch of other companies like that. And that really paid off.
Yeah, so looking at your performance chart, in terms of squeezing value for our listeners, I would encourage people to ask yourselves, how would you feel, I suppose, if you lost in 2006 1.4%? Probably, no big deal, right? Then look, next year you make 54%. Yay, right. But then you lose 4%, not that bad. Okay, sure. But what do you do in a year like 2022 when the whole portfolio, drops 38%? And that's where the whole, I think, double down on the process and due diligence in stealing your loins, girding your loins really pays off, because one of those years could pop out of seemingly nowhere, right? Yeah. So anyway, Badger, kudos to you for, surviving that kind of year and then following that up with, really, really good numbers.
Hey, listeners, my name is Brett Schaefer, one of the hosts of the Chit Chat Stocks podcast. On our show, we do comprehensive stock research reports, interview analysts, and learn from great investors. And we have coverage on stocks like Airbnb, Nubank, Mercado Libre, and many others. Plus, we cover all the hot financial news on our weekly investing power hours. We have episodes for all types of investors, and think if you listen to this podcast, you will enjoy ours as well. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts and start discovering new investments today.
Yeah, like 2022 was tough. I think I said on other podcasts, like, I had just retired. I was just suddenly being a net withdrawer from my portfolio, and this was like going to fund, the next 1,000 years. And suddenly I took like a, nearly a 40% haircut. So that certainly made me like question myself. But I just doubled down on doing fundamental research and not panicking. And I think actually, like, my performance in 2023 and 2024 and year to date like I've beaten the market pretty soundly, and I'm now back above like my all-time high that was set in 2021. Like mostly most of my alpha there was because like I was investing when everyone else was panicking and selling in 2022. If you were a growth investor, you were selling in 2022. Like the streets, there was panic and fear. Like I was just putting my cash back into play and trying to buy companies that felt beaten down, like CrowdStrike, and trying to add to these like secular long-term winners. So I'm now starting to see the benefits of those investments made in that year.
And the other obvious point I think to make is you're beating the index quite regularly. So in the down years, right, having owning all the companies is better, but in the up years, being very selective about what you own is the greater alpha, and in general that creates the larger alpha. It's just that the your worst years are more painful for you, obviously, but your good years more than make up for it. So you, moral of the story, just have to have more of that inner fortitude and the right behavioral psychology to withstand the down years for your up years to make it a good strategy.
Yeah, and have a process, and then be honest with yourself and track your results and like analyze your decisions and just try and improve. Like I just try and get 1% better. Like every week, every time we do a podcast, I try and be a tiny bit better. Like those improvements compound. Like really, we've skipped over like a whole bunch of slides, but really the story Coatue are focusing on for this year is the AI story, and maybe this what they position as the AI flywheel is kind of the key to that. Do you want to unpack this one a little bit?
Sure, it shows that you get the AI brain creating the technology that makes lower unit labor cost, which then lowers inflation because prices drop. That gets lower interest rates. That gets to higher GDP growth. That gets you to more income via taxes. Then that gets you to a lower debt to GDP ratio, which then lowers unit labor cost. So I think this is, if true, this is the optimistic scenario in how the US avoids the debt crisis. Because if you have to remember debt without context means nothing. It's relative to the economy and how quickly the economy is growing. So if the magic of AI can actually begin accelerating and getting in front of the debt, then we don't really have a problem, right? And I think it's possible. I don't think this is a pie in the sky kind of thing. The only, I suppose, critique I have of this has to do with the nature of paradigm shifts. That they haven't happened. This is obviously going to restructure the world in so many ways. Potentially, revolutions might happen, right? I mean, like things might be destabilized. There might be a really wobbly period. What happens if there is a default on U.S. debt before this gets going, so on and so forth. So I don't have. I like the theory. I just don't know if I could turn this into anything useful, like actionably useful in this moment.
Yeah, that's an interesting point. Maybe you're right. Like the only action here is you would invest in the companies enabling those efficiencies if you kind of buy the story. I mean, maybe I think I buy the AI story, even if it doesn't like drive this flywheel and ultimately fix like the massive debt problem the US has. Because I feel like AI is probably not going to come quick enough to drive this deflationary cycle, and the US have kind of buried this problem, this like debt crisis under the carpet for now. But you only be able to do that for so long. Like your visitor's going to come over and they'll be like, "What's that lump in the lounge?" And you're trying to like hide it with a sofa, and it's going to get too big at some point.
One more critique potentially. You see the where it says higher tax receipts?
Yeah,
Well, that really depends on the kind of government structure we agree to, right? Which party is basically in power, so to speak. And I'm not convinced that the winners, say, for example, let's say Tesla is one of the winners here, that they will give back, so to speak, as much as they find a way to create a loophole and keep more for themselves one way or another.
Maybe like if we were to simplify this flywheel, though, it's like AI creates cost efficiencies and more stuff gets done, more economic value gets generated. So, like, I don't know, simplistic example, but leaning into what you were just saying, like let's say Tesla successfully deploy robotaxi across the whole of the continental US in the next couple of years, and then suddenly like logistics and meetings and like remote work and different things suddenly become cheaper and easier to do because it's like the cost of going from A to B is suddenly like cut down by 90%. And so that's economic value that the whole of society will experience. People are spending less on taxis, let's say, so they got more money to spend on Netflix or whatever in a restaurant or something. So then there's more restaurants and they're in more diverse locations. So then it enables like smaller communities. I'm just giving like a weird example, but essentially, like more stuff gets done, more economic value. So that's where like higher tax receipts ultimately come from.
Yeah, I buy that if it's trickling down, so to speak. I'm skeptical potentially if it's up to sort of the people with more money to, not stuff it under their mattress, but to actually give back what proportionally what needs to be given back. But that remains to be seen.
Well, like, luckily, a free market causes that. Like, as long as Tesla are not the only game in town, they'll get forced to lower costs because they're in competition with like Waymo and Uber and then BYD and whoever else is playing in that same space.
And of course, there's a wild card here, not even on this, is the possibility or potentiality of universal basic income, and where does that fit in? So I don't know. Nobody knows, I think, at this moment.
So one last slide before we really get to like the big conclusion, but it is interesting. So remember, Coatue invest in private markets and in public markets. And I think what they're pointing at with this slide, like they're saying innovation is everywhere across all these different sectors, but actually, like it's interesting to note that the valuations of private companies are really getting significant. Like SpaceX at $350 billion, like is one of the world's biggest companies, but it's not a public company. And say Revolut, like I'm a fan of and an investor and a customer of Wise, but Revolut are private. They're not really competitors, but they are in the same space. Like they're essentially like a fintech bank. Like their valuation is double Wise's valuation.
All I could squeeze out of this is that I'm getting a little bit of the 21-22 vibes. And maybe that's just recent trauma. Who knows if history will repeat? But we've been talking about this quite a bit, right? Like in these kinds of market moments, there's a reason to be optimistic because yes, companies are being built, and now you have the most powerful technology of all time backing it. So maybe that extends the market cycle for far longer than it's ever been extended. And also caution. I mean, we do know that things can get overheated and overly optimistic, and now you're paying whatever, the math, the basic math just goes out the window. And I think all the other things being equal, if you're not cautious, you will be burnt, and quite badly potentially, if you don't really back the correct horse.
And you either believe in the AI cycle or you don't, I suppose. And then maybe becomes, we always talk about in recent weeks, like narrative versus numbers. Like AI is still like a narrative theme. It will become a numbers theme at some point. And certainly it's a numbers theme when it comes to like a company like Nvidia, who are literally just like they cannot make enough hardware to fulfill like the demand for this stuff. But maybe the bubble pops for different reasons.
So the next slide shows us today's top 50 tech companies. What's interesting about this slide to you?
It's interesting to see Bitcoin in there, in sort of top six, like mixed up with the Magnificent Seven. It's a bit of a kind of false analogy, really. Like it's not a company, but as an asset class. Like if you were to put gold on here, I don't know where it would sit, probably above Microsoft. But it's interesting that Coatue think of it as a like a tech company. Like obviously they're putting like air quotes around that.
Well,
But yeah,
also and also Badger, Ethereum is on here. So Ethereum, remember, Bitcoin is like the OG of crypto stuff, but Ethereum is basically the world's
yeah,
decentralized computer, and that's between
yeah,
Palantir and ASML. And
yeah,
so that they're calling them tech companies is of interest. And obviously, as a big Chainlink guy myself, I'm like, ah, okay, yeah,
yeah,
they're not just outright dismissing the big players.
yeah. Like this is objectively an elite list. Like these are the top 50 by market cap, the top 50 tech companies in the world today. And the next slide is the interesting one, but it's hard to argue with the dominance of companies like Microsoft, Nvidia, Apple, Amazon, Alphabet, right?
All right, so let's get to the next slide. I mean, this kind of is sort of the big payoff for the slide deck, right? I mean, it's kind of their list of the 40 companies they think in 2030, so 5 years from now, will be the champs, right? So it's their ranking of it's their crystal ball. Um, I really hope we remember 5 years from now to look back and compare what they thought would happen versus what did happen. What's most interesting to you about this list?
There's a whole bunch I think we should talk about here. Like, I think this is not, I'm guessing, because unless I've gone blind, there is no Alphabet slash Google anywhere in this list. So I'm guessing they are not saying these are going to be the world's 40 most valuable tech companies. These are their fantastic 40, i.e., these are like the tech companies that fit their methodology. And if you remember, like their methodology was the top 150 companies which are growing and exclude companies facing margin compression. So I guess when you apply that methodology, these are like their 40 favorite investments. So let's talk about the stuff that's in the list, and then we can talk about some of the stuff that's not in the list. Like, so one that caught my eye, SpaceX. So SpaceX today is a $350 billion valuation. They're pegging SpaceX at $870 billion in 2030. I think I buy that. That's like a bit more than a double over the next 5 years. The trajectory looks good for that.
Right. I noticed that Snowflake is not on here, but they have Databricks. So for people in the SaaS slash AI databases world, they're they're obviously giving Databricks the thumbs up and no ad space to Snowflake.
Yeah, that's a good observation. Agree. Yeah.
I'll also say, not that I was expecting this, but because they are in the Bitcoin, I mean, I'm sorry, in the crypto space, they're not burying their heads in the sand. They have Bitcoin at $5 trillion, which I think it might be actually a little conservative if the current pattern continues to play out. They have Ethereum still dominating, but to no surprise, they do not have Chainlink anywhere on there, and to me, those are the big three. So maybe they just haven't done the work, or maybe it's just too much of an asymmetric moment right now for them to make that kind of call.
Yeah, like Chainlink is a minnow and a different kind of thing. So maybe they like it, but it's just not on their radar because it's too small for them right now, perhaps, and they believe it's still going to be too small in 2030. Probably hard to argue with that. Again, we both need to take a look at Oracle. They're pegging Oracle as being a nearly $1.5 trillion valuation in 2030.
Mhm. I'm a little surprised Netflix still being so high up. And that's only because if I kind of compare, the internet era, how quickly sort of entertainment type stuff, kind of like fashion, could go out of style. I love Netflix, but to see it basically be right there next to the companies that create reality is a little bit odd. And that would be one of my first bets to say, what if, I don't know, some next better thing comes along and virtual reality takes, the place of streaming movies, and, all the customers go to the new thing. So
But the new thing is looking increasingly like it's going to be like personalized entertainment. So, like, the Netflix show that I watch will be different and have different actors and a different like course trajectory than the thing that you watched. Because maybe I'm into horror and you're into like drama or something.
And
So
right, and I mean, that's why I think Meta could be justified, because it's not just Facebook, but they're working on the metaverse and so on. So if that works out, that's the horse to back.
and I think they might have been a bit optimistic with Intuitive Surgical. Like, they and I have owned this one for a long time, but they've got Intuitive climbing from a market cap today of $185 billion up to $460 billion. Like, I think they're going to grow. I don't think they're going to nearly 2.5x over the next 5 years. Like, Intuitive are pretty embedded. Like, this is now a mature company with like on the fifth major iteration of its product set that's embedded in most of the world's hospitals, certainly in the West and in China. So like, there's going to be growth, but I don't know if it's going to be like 2.5 bagger territory.
Stripe is at 511. I mean, that's a company right up your alley, but it's private. Have you done any work on trying to become an owner of Stripe?
I've not, no, the valuation's big even today. Like, they were in the same territory as SpaceX as being like vying for the world's most expensive / valuable private company, although SpaceX have outstripped them now. And yeah, it just didn't appeal. Like, I own other stuff in that space that's public market and is significantly cheaper than their private market valuation today.
But see, that's the question, though. This is in your Stripes in your wheelhouse because of your expertise in that particular domain. And these guys are saying that they expect Stripe to be even more valuable by probably by a lot to make it into the 19th position at 511 billion. So why wouldn't you be incentivized to do more work on becoming a Stripe owner?
Wait, I mean, I can't sort of pitch and try and get access to these things. They either hit my radar or they don't, because I'm a tiny guy writing small checks. So if it did come up as an opportunity, then I'd look at it in more detail. But there's like a lot of hurdles to jump when you invest in private market stuff. There's a whole bunch of costs and complexity and like back end and terms that might be inferior to like other classes of shareholder. Like, it's like it needs to be like a multi-bagger investment over a reasonable period of time to make any sense at all. Because most of them, well, not when you're in Stripe's league, but most like smaller companies fail, to be honest. They don't get there.
I need to look into this GE Vernova company. I've heard obviously of GE before, but I don't know what GE Vernova is.
That's kind of my first job, actually. My first ever job out of university was working for EDS, like a kind of like a consultancy / software developer. I was working on air traffic control software, and they were like a subsidiary, I think, of GE. No, they weren't. Actually, no, I've got that wrong. They were a subsidiary of GM, not GE. Anyway, another G company. Forget what I said.
Okay.
But anyway, GE is your wheelhouse. Yeah.
Anyway, let's put a reminder. Can our calendars do that? Remind me 5 years on July 30th in 2030 to look at this slide and see what the reality is versus their expectations. That'll be fascinating. True.
Yeah, well, let's stick it on our radar for stuff we come back to every year, because I'm hoping this is the first time I think they've published the Fantastic 40. So let's just like monitor Philippe's track record. Yeah. I do have a bone to pick. And I think I know the answer to this, but I'm just going to go at it, right? Where the heck is Alphabet on their chart in their Fantastic 40? It does not appear, right? And here are some beautiful numbers from our friends at fiscal.ai. Fantastic. and stock analysis service, company analysis service. So like on my pretty picture here, Google Alphabet is the purple and the blue line, right? So much lower market cap, $2.3 trillion versus Microsoft's $3.8 trillion, and revenues of Google's that are much higher on the last sort of last 12 months basis directionally. Alphabet are doing $370 billion a year of revenue. Microsoft are doing $270 billion a year of revenue. So better, much better valuation. And I think a much better trajectory than Microsoft, even though Microsoft have tried to reinvent themselves. And if you go and look at some of the slides we didn't show in this deck, like Philippe has positioned Microsoft as, oh no, we did look at this slide. It was the peaks and troughs slides. And if you go back and look at some of the other slides in this deck, Philippe has labeled Microsoft as leading the reasoning moment. What the F? Like, no, that's not the case. They don't, like, they try to buy a piece of OpenAI and partner with them and embed OpenAI, and now that relationship is like questionable. Yeah, okay, they've got Copilot and they've embedded some of that stuff into their product set. Are they leading reasoning? They're not, right? The people who are leading reasoning are OpenAI, are Anthropic, are Alphabet.
So Badger, so right, they're insulting your thesis in favor of Google, basically by omitting them, and that's why I think you're asking good questions. But I think this shows the other problem. Now, I don't understand in that case their what's it called, their methodology, exclude multiple compression versus the market. Well, according to your chart, Microsoft is the company that has the higher multiple, right? They're worth more, but they make less money than Google. So if any company is going to compress, it's going to be Microsoft, not Google. So they're in terms of multiple, then they obviously must outright just not believe Google will be right. Will be able to cross this AI chasm.
Yeah, I'm glad you went there because this was my conclusion. But I think you've done it the other way around. So I think they've excluded Alphabet because Alphabet has experienced market like valuation compression versus the market.
Oh, has
Whereas,
rather than will.
yeah, exactly, has. Whereas Microsoft
Oh,
valuation multiple has expanded because if we go back to what you always say about technical trading, even though neither of us are technical traders, but you say when you apply this sort of simplistic lens, if price go up, good, if price go down, bad. And like the price of Alphabet has gone up, but the valuation in terms of like PE or price to free cash flow, like whichever valuation ratio you look at, Alphabet's getting cheaper and cheaper. So the multiple is compressing. And so I think that's why they've excluded it. And if it was, here's my kind of critique slash, okay, I kind of agree. Like if they literally just took that as a blunt tool and they said, we're going to now just chop out blindly any company where the multiple is compressing, well, that's just dumb. I don't believe they're doing that because it's companies where the valuation is improving and the company is still growing. Like if all the other metrics are looking good, but the valuation is improving, they are the companies you want to invest in, not the ones you want to disinvest from and ignore. So I can't believe for a second that's what Coatue are doing. I think what they're doing, because they're putting together like a nice pretty slide and making it simple. What they're really doing with that filter is they're doing a whole bunch of very deep, nuanced work where they're not just looking at the multiple, like they're understanding the reason for the compression. And like there are good reasons why something could get cheaper because maybe like the market, well, not that's okay. There are good reasons why a multiple might be compressing, and there are bad reasons why a multiple might be compressing. And I'm certain they're doing that work. And probably it's just that their view and my view disagree, and we both understand these companies well, and we just happen to disagree on the facts, which is fine. That's how a market gets made. Someone's a seller and someone else is a buyer.
Yeah, agree with everything you said. Blunt instruments are to be used bluntly, and in this case, this is such an interesting moment. You have these world class investors basically tossing the egg at a company that you recently gave 10 out of 10 badgers, and you defended your thesis, I think, quite adroitly, if I may. Like with this, you have a sophisticated series of thesis statements, and these guys are, I mean, I don't know, maybe there's some other hidden thing, who knows, but these guys are obviously disagreeing with you in a way that, now that you pointed it out, is very, very strange. They must legitimately not believe the same things you believe, and for what it's worth, I'm on your side in this one.
Sure. Time will tell. Like, I guess it is the fear around AI disintermediating search, and that's going to lead to like revenue declines, I suppose. But they haven't published anything on that. But that's a reasonable thing to believe based on the current position. I just happen to believe otherwise.
All right.
All right. Anyway, it's a good deck. I like it. I think we should definitely thank you to Kaylin for bringing this to our attention, and we should definitely come back and look at this in future years.
Yeah, and it certainly put a couple of companies on my research list. Top of them is Oracle, as we mentioned. I also need to do a little bit more digging about Broadcom, to be honest. I'm staying away from market, mega caps. But when something that is that big, and I don't really have a good handle on what they even do, unlike the other ones, I gotta figure out what I'm missing. Plus the GE Vernova company, because it's in that AI energy space, and I need to find out what they're seeing.
Yeah, and I own Snowflake, and I've not had an opportunity to look at buying Databricks, so I'm going to sniff around there a little bit more.
And I'm sure it feels good for you to see Mercado Libre on the list and CrowdStrike still on the list.
Yeah, yep, definitely. All right, so that was good. Interesting conversation. We'll come back to that again in a year's time. Well, you have been listening to Wall Street Wildlife. We do lean heavily on fiscal.ai, excellent research tool, and we use it every episode. So do check it out. If you want to get a tasty discount, go to fiscal.ai/wildlife.
Are you ready to become a beast of an investor?
Your journey starts here.
A reminder that the people on this program may hold positions in the companies that are mentioned. Buying and selling stock carries financial risk, which could include loss of capital. The views in this program should not be taken as personalized advice. Before acting on any of the information provided, listeners are encouraged to consult a financial or tax professional.